The Chinese stock market, already weak going into the end of 2015, has started 2016 off with a bang, literally crashing on a near daily basis by hitting the 7% circuit breaker daily limit moves, prompting a closure of the market, only to resume the free fall on the following morning's open as investors panic sold on the opening, attempting to sell before the circuit breaker kicks in, resulting in a market that has locked out most retail participants as they watch their stock portfolio valuations evaporate. This daily 7% limit down crashes prompted the Chinese authorities on Thursday to suspend the circuit breaker, which should have the effect of alleviating the panic selling going forward. However, damage has been done as China's crisis has spread and hit the global stock markets hard, after already ending 2015 on a weak note and now bringing daily bouts of selling right across the board, which, whilst not on the scale of China's panic, nevertheless each day's selling has done at least some technical damage to many bull market indices. This graph further illustrates how China's stock market SSE index has dragged the major global stock market indices lower since just before the start of 2016. Here is plotted the Dow, FTSE, DAX, all plotted against the China SSE index. The impact of China on global stock markets greatly could not have been any worse, as major indices have had their worst opening start to a new year for decades. Of course, for China, the world's second largest economy, it's a case of fundamentals of a weakening economy that, despite Communist Party propaganda, expectations for 6.5% GDP growth for this year, which in my opinion would be lucky to beat 4%. What's worse is the growing risk that China's debt bubble poses, that has seen total debt rise from about 160% of GDP 10 years ago to currently stand at 250% of GDP. That in a worst case scenario could trigger a 2008 style Chinese financial crisis, which the likes of George Soros have been busy declaring as imminent, that would soon consume China's 3.3 trillion of reserves, which is already being consumed at the rate of about 100 billion per month, thus triggering waves of selling of foreign investments held by Chinese sovereign wealth funds so as to support the domestic economy, that would ripple out right across the Western markets, which would literally trigger central banks to inject fresh QE into local bond and stock markets. My long-standing forecast for the Chinese stock market was for the SSEC index to spend the remainder of 2015 stuck in a trading range of about 3,500 to 3,000 from the then level of 3,400. The updated chart reveals that China has in large part followed the script, which, despite the recent price plunges, the SSEC has so far not significantly extended outside of its trading range. That is likely to persist well into 2016, which therefore implies further downside is limited, and with heavy support in the 2,800 to 3,000 region, against the most recent close of 3,125. So at this point in time, the all-prevailing doom and gloom in the mainstream media is not really justified. Not until the 2,800 spot breaks, which, as my earlier in-depth analysis suggested, would target a drop to 2,500. So the bottom line is that whilst today's daily 7% limit down drops are not pretty and fostering much attention from the usually clueless mainstream media, however, technically the SSEC remains in a trading range of approximately 3,800 to 3,000, with a last close of 3,125 near the bottom of the range. So as of writings, SSEC appears to be very near making a bottom, which is a far cry from the widespread doom and gloom and panic out there. And briefly, a quick interim technical take of the Dow ahead of my forthcoming in-depth analysis and detailed stock market trend forecast for 2016. The Dow's last close of 16,514 has taken the Dow significantly below support of 17,000, never mind attempts to break above 18k, so the Dow starts 2016 technically weakened, which means for the bull market to attempt to resume a trend towards a series of new all-time highs, then will need to recover back into the range 18,000 to 17,000. Whilst the downside, the next major support kicks in around Dow 16k. However, rather than continuing its plunge towards Dow 16k, probability instead favours the Dow attempting to regain the 18k to 17k trading range, which thus should be the stock market's direction over the next week or so. This graph further illustrates that the Dow merchants are once more running ahead of themselves, and that most are conveniently ignoring the fact that they have been wrong for 7 years, during which time, had they followed their so-called market calls with actual trading positions, then they would have been wiped out several times each year. The bottom line is that despite recent price falls, the Dow is only 10% off its all-time high of 18,351 and well within its 20% corrective trading range of between 18,351 and 15,500, which could turn out to be the pattern for 2016. And remember that this is just my interim analysis ahead of in-depth analysis that will conclude in detailed trend forecasts across several major markets, so ensure you are subscribed to this YouTube channel, as future analysis will cover interest rates, US dollar trend, US house prices, the stock market, crude oil and gold and silver, all within the next few weeks.